Okay, I think we're finally got everything working. Welcome to, what are we, night 19? Night 19 of our 24 nights of live streams, breaking down all the provisions of the 2024 legislative package, the Trump-Biden peace plan. As always, we start these sessions off by reciting the preamble to the Constitution. And so, invited to join me. We, the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty to ourselves and our posterity, do ordain and establish this Constitution for the United States of America. These are our 5 duties as Americans, and tonight we're going to continue with Title IV, promoting the general welfare in the legislative package. Last night we talked about unconditional basic income and how this fulfills our duty to secure the blessings of liberty to ourselves, and it fulfills our duty to secure the blessings of liberty by giving people options, giving people choices, and it also addresses our duty to promote the general welfare and helping the health, happiness, and prosperity of Americans. So coupled with that, we've got the value added tax, which we're going to talk about tonight. Taxes, many people don't like taxes, totally understandable, but they are a part of fulfilling these duties as well, because concentrations of wealth, concentrations of economic power can disrupt the freedom and liberty of others. It can reduce their choices where they're no longer able to exercise the choices that they would like in their own lives. And so the value added tax is a consumption tax. It is, so the more that you consume, the more that you buy, the more that you spend, the more you will pay. So the people at the top of the economic ladder who spend the most are going to pay the most. People at the bottom who spend the least are going to pay the least. And since we've set an economic floor with unconditional basic income, those at the bottom will spend only a small percentage of their UBI as in paying for this new tax, whereas those at the top will pay far more in taxes than they receive in UBI. And so these two lines, the consumption tax burden line slopes at an angle, right? It goes up the more and more you spend, whereas UBI is flat. Everyone gets an American Union job. Everyone gets the same $16,800 a year. And so at some point, those two lines cross. And by fiddling with these lines, we can decide what percentage of the American population comes out ahead from UBI and what percentage are net payers, people that pay more than they receive in UBI. And all along that span of economic span of income, span of spending, it's progressive, it's graduated, right? There will be people who will end up paying $1 more in tax than they get in UBI. They're virtually at the break-even point, and then people will be coming out $1 ahead from their UBI versus how much they're paying in extra taxes. And so rather than doing complicated means testing and things like that, we can just draw lines that will serve the function of addressing wealth inequality in the United States. And so the way that we've drawn this line between UBI and the value-added tax, you can estimate that about 80% of Americans will come out ahead. A family of 4 will have to spend about $250,000 a year in order to pay back their UBI in taxes. And so people spending less than that will come out ahead. Just one other quick note on tax policy. What is the purpose of taxes? And the purposes of taxes is not necessarily to fund government, because the United States has the ability to print money, to create money, which we're harnessing with the Treasury dollar bills. So the purpose of taxes is to steer policy for the United States. What kind of nation do we want to be? And so there's five main points, five main policy things that you can use taxes to steer the country. One of them is, of course, keeping the value of the dollar relatively stable. And so if you just print money but don't collect any of it back, you get inflation. You get widespread inflation. This is what happened in the Revolutionary War, where Congress printed continentals, but Congress had the ability, the authority under the Articles of Confederation to print continentals, but they didn't have the authority to tax it back. And so they just went out in there in circulation and suffered, and the United States suffered from inflation. So taxing it back to keep the growth of the money supply where it keeps the value of the dollar stable. That's one. Another is to address societal goals as far as the distribution of income and wealth inequality. And so this is what the value added tax does. A third thing is to steer industry, steer other national goals. So we're going to do that. We're going to talk about that next Monday or Sunday with our pollution taxes. We're going to create a financial incentive for people to pollute less as one of the other clawbacks for unconditional basic income. The fourth thing is as an accounting measure. If you know if you're gonna spend this much, you can also tax back that much so that things kind of pay for themselves. This is what we do with things like, the gas tax to pay for roads, Social Security, Medicare, things like that. That the taxing is to cover the costs of a specific program. And last, taxes can also be used to guide public policy of individual choices. Things like the cigarette tax to discourage people from smoking. Things like the 12% tax on recreational drugs included in the Trump-Biden peace plan to discourage people from using recreational drugs and to address the harms that they cause. So those five things are the reasons that you need taxes in a healthy, functional society. So again, we may not like paying taxes, but they are a necessary thing. All right, digging into the Trump-Biden peace plan, section 441 is the findings for the value-added tax. I'm just going to go ahead and read those. I'll go ahead and pull it up on the screen here. And then we'll keep moving right ahead. Okay. All right. Congress finds the following. The utilization of America's productive capacity has trended downward over the last 50 years as wages have not kept up with increases in productivity. The issuances of Treasury dollar bills will enable an increase in purchasing power and drive further economic development by bridging the gap between wage income and productive output. 2. Issuing Treasury dollar bills in sufficient quantities to end poverty will free up additional resources that are currently being diverted to address problems spurred by poverty, such as crime and increased healthcare usage. However, these quantities may cause inflation beyond normal targets. Therefore, some of the increase should be taxed back, clawed back, to remove it from circulation and fund government expenditures without borrowing money at interest. 3. Wealth inequality distorts the marketplaces and decreases the quality of life for citizens. A value-added tax, VAT, is a consumption tax. Those who spend the most will pay the most. Combined with unconditional basic income, it is a progressive tax. 4. A 2011 report by the Congressional Research Service concluded the imposition of a VAT would cause a one-time increase in this country's price level, but a VAT would not necessarily affect the country's future rate of inflation if the Federal Reserve offset the contractionary effects of a VAT with a more expansionary monetary policy. 5. The United States is the only member of the Organization for Economic Cooperation and Development, OECD, without a VAT. The purpose of the value-added tax is to address wealth inequality while clawing back some of the increase in the money supply. Again, a value-added tax is a very common tax worldwide. This combination of UBI and value-added tax was popularized by Andrew Yang's campaign for president in 2019. And so we've really got to understand this. You got to ask the question, what is value? What is the value that's being added? And it's the difference between your raw inputs and your outputs, your selling price. And in many cases, it's almost entirely human labor that creates the value. You know, if you buy a $500 computer and you write a piece of software that you turn around and sell for $100,000, you've created $95,000 worth of value. But what happens if automation or if AI creates this, right? You buy a $500 computer and you ask ChatGPT or one of these other AI things to write you an app, and then you sell the app for $100,000. Well, you've still created $95,000 worth of value. Now, when companies do this, in the past, they hired software engineers and things like that then their income would recapture through the income tax, would recapture that value. But as AI will lessen the need for human labor to produce the same products and services, especially in technological areas, we're losing some of that. And so by taxing value, regardless of how it's created, doesn't matter whether it's a human or a computer, we address this. So there is no financial incentive to lay off workers in order to reduce your tax burden as a company to the value-added tax. So a lot of the language in this section comes from HR 6110. It was legislation introduced by Paul Ryan in 2008 as part of a broad tax restructuring package. And his proposal set up a more traditional VAT as they practice in Europe, where it's essentially a sales tax that shows up on your receipt, and then a business who's buying things can then deduct the amount of tax they've already paid from the amount they got to pay forward. And anyways, this is a subtraction method value added tax, so it simplifies it as well as avoids sticker shock. It would be baked into the cost of goods and services that everyone buys, and businesses would pay that. Basically, a business would calculate how much were the physical things that you bought, the physical inputs, and then how much did you bring in sales, and then subtract. That's the amount of value your company has added, and then you would pay 12% of that. And so we say, and so really, since this helps to offset the costs of unconditional basic income, this is a reinvestment back into the economy. If you're benefiting from the economy, then you'll pay 12% of that back to help keep the economy flowing. And and the reason is because all of our accomplishments, everything you see in this economy is all of these successes are built on the accomplishments of others, right? We're all speaking English right now not because any of us invented English or any of us sat down and calculated what is the best language, most efficient language for us to speak. No, it's because this is what society has, what American society has developed, and we all benefit from that, even without having to do any work, right? We all get to drive on the Eisenhower interstate system. It facilitates transportation around the country. It makes things like Amazon possible, that they're able to move goods around the country. Amazon utilizes the postal service to do those last mile of deliveries in many cases. Again, none of these, and Amazon uses the internet and all these things. Amazon found a different way to put a business model together, but the pieces that they used were overwhelmingly created by others. And so by accepting that we're all contributing to we all contribute to the value in society, we pay it forward to ensure that the future generations have the same opportunities that we do. The more successful we are, the more we contribute. All right. And the other one thing I do want to show real quick, if I can. Let's see if I can pull this up. Nah. Maybe I should just put this on another slide. All right, yeah, sorry. Let me try and share this. So Japan has had very little inflation and even had deflation for many, many years. And so one of the things that they tried in 2014, because prevailing economic theory was you've got to have inflation so that to help your economy grow. So they bumped their value-added tax up from, I think it was by 3%. I think it was from 7% to 10%. And so you can see exactly what happened in 2014. Their inflation bumped up by 3% for about a year, and then it came right back. Then once it was baked in, it came right back down to zero, even into some deflation, and stayed there. The value-added tax did not cause an inflationary spiral. It was a one-time bump in prices, just like the Congressional Research Service said would happen here. So, all right. With all that being said, let's start looking at the text of section 452. Section 452 adds a new chapter to the Internal Revenue Code, and it's broken down into 5 different subchapters with a total of 27 sections. It's a lot of work being done here. And so let's look at each of these separately. The first one is subchapter A, the imposition of the tax. I'm going to jump down real quick to section 1604, the voluntary value sharing, because that's sort of a separate aspect of this. All right, so what this means is we've talked about is the other way of the 2 ways that Treasury dollar bills can be issued. One of them is by the main primary way is through the American Union Jobs Program, through UBI, about $4.5 trillion issued per year. And Congress is prohibited from issuing them in any other way, except for through the voluntary value sharing program. And what this does is it allows any entity subject to the value-added tax to share an amount of their gross profits in excess of the requirements of this chapter, and using that amount to pay down the national debt, and then redistributing that amount as Treasury dollar bills. This distribution, I don't remember if we got into the details, would be an equal amount for every citizen, period. Every man, woman, and child, like Alaska's oil dividend, every man, woman, and child gets the same directly to their account. So we talked about UBI a children's benefit being split between the parents. In this case, the voluntary value sharing goes right to a child's account. All right, business entities can just declare. These declarations would have the force of law. If they say, instead of 12%, we're going to contribute 13% this year, we're going to give something back, that would have the force of law. That would be bound by their commitment. And they could do it in different ways, by a percentage. Again, say 13%. They could say, we're going to donate an extra $1 million this year for the voluntary value sharing. Or just a total amount, and say we're going to pay a total of $1 billion this year. Doesn't matter what our actual liability is. We're just going to pay $1 billion. And regulations can provide for other options. And the secretary will keep track of those, report them on October 15th, and annually thereafter. Maintain a publicly searchable database, and in that, so you could see how much businesses have contributed, if any, and then publicize a ranked list of the business entities with the highest voluntary value sharing for the previous year. For companies with gross profits less than $1 million, between $1 million and $100 million, and greater than or equal to $100 million, and by their total amount. If there's not that many companies that have over $100 million in gross profits, so if there is less than 200 that appear on the list, the secretary shall fill in the rank list with the business entities reporting the highest gross profits and signify the amount contributed was 0. Yeah. So what you're really doing there is you're saying, okay, you big tech companies, we're gonna give you an opportunity to compete. First off, so the voluntary value sharing would be distributed around at the end of the year, around December 1st. So essentially, it is a year-end Christmas bonus for the American people. So which of these big tech companies want to have their name associated with this year-end bonus for the Americans? And by publicizing a list, you give these companies an opportunity to have bragging rights. You give them an opportunity to where is it? Yeah, you give them the opportunity to compete against each other for doing the most. A couple other reasons that you might want to do it is for, it's public relations, as we just said. It's apologies, kind of reparations for doing something wrong. If a company gets, caught in a scandal, okay, we're going to donate $1 million or whatever to the voluntary value sharing program. We're sorry, and this is how we're going to make amends. We're going to do it in a way, though, that benefits everyone for the harm. Or it could be for windfall profits. Something happens where all of a sudden you're making a whole lot of extra profit, unexpected profit this year. You can give some back to the American people. And so the voluntary value sharing sets up a mechanism for doing that. All right. That being said, all right, let's go back and actually start working our way through the legislation. That's the one. Yeah, that's the different thing. All right, so Section 1601 is the definitions, and definitions. Actually, I'm going to jump around just a little bit more. We're going to skip to Section 1602. We'll come back to the definitions. The definitions do an awful lot of heavy lifting. I took computer programming in high school, And our teacher said, you know, when you get good, you'll be able to write programs that are only like 6 lines long, because they're going to call up subroutines and subprograms that will actually do all of the heavy lifting. And so that's sort of the case in this section, where the definitions, the callbacks to the definitions, do a lot of the heavy lifting and a lot of the details. So let's look at what they do, and then we'll skim back through. All right. Value-added tax is imposed on business activities in the United States by a business entity for each taxable year beginning January 1, 2026. That amount is 12% of the gross profits, and by the middle of the year 2025, rules, regulations, things like that. The value-added tax does not apply to nonprofits. They do not have to pay the value-added tax because as a nonprofit. However, they're still going to pay the value-added tax when they buy goods and services and everything, because it's already baked in. It'll be baked into the prices. The exception is sort of unrelated business activities. So colleges and universities that, you know, have vendors, have, you know, do buying and selling of goods and services, things like that. Those activities would be subject to payment of the value-added tax. And then regulations. Okay. All right. Now let's come back to, remember those definitions, those things that we just said. Okay. So what is business activity? Means sale of property, services, leasing, development of property, services, but does not include performance of services by an employee or the casual or occasional sales of property. So you sell your used truck and you make a profit on it. You don't have to. It's not. It's the casual or occasional sale of property. So you don't have to pay. You're exempt from the value-added tax. Business entity means any, you know, business association, but does not include, has a safe harbor for any entities whose taxable receipts are less than 3 times the basic wage. So whatever the UBI is, there's a safe harbor. If your small business whose taxable receipts, the amount of money that you're bringing in, is less than 3 times the basic wage. So 16 times 3 is 48 times 8. So that's $50,400. Yeah, $50,400. If your taxable receipts are under that, then you're exempt. Business entity does also not include a governmental entity carrying out an essential government function. If it's a non-essential function, you know, again, selling liquor, some states have government-run liquor stores, things like that, then they would still be subject to the value-added tax. That's not an essential government function. All right. Business purchases, these are the things that you deduct from your gross receipts. That includes buying supplies, inventory, purchase of services from a business entity. Remember, business entities are making at least $50,000 a year. So you can't use this as a loophole and say somebody is an independent contractor. If they're making less than $50,000 a year, they are not a business entity. And so your big business, will still pay the value-added tax. Purchase of financial intermediation services, amounts paid to winners in lottery, imports, and does not include compensation. So compensation, wages, salaries are not included. Purchase or rental of real property, purchase or rental of capital equipment, property acquired outside the United States, services performed outside the United States. Again, this only applies to the United States. Interest, dividends are not business purchases, and expenses related to advertising is not a business expense. That specifies what exactly compensation expenses are, which are not included as business expenses. Deductible amounts, employees. Gross profit means for a taxable year of a business entity, the amount by which the taxable receipts exceed the deductible amounts for the business entity of the taxable year. Again, so whatever the cost of your physical inputs into producing the goods or services minus the amount of your taxable receipts. Import tax, we're going to cover that. And product tax is any other tax imposed by the government. Property means a product for purchase or sale. Does not include real property unless specified or would clearly be applicable. Taxable receipts means all receipts from games of chance, in-kind receipts, contributions, taxes. Sorry, not taxes. Taxable receipts do not include contributions of cash to a business entity. So if you put in $50,000 to start up your business, that is not a taxable receipt. Taxes do not include any taxable receipts do not include any taxes. So again, if you collect a sales tax, the sales tax that you're collecting is not part of your taxable receipts. And exports are excluded. So anything that you're selling outside of the United States is not a taxable receipt, unless such exports are part of the unless they're military equipment, military hardware, military. They're subject to the Arms Control Act. Performance of services. Services means permitting use of property, including rental of real estate, performance for entertainment, presentation of ads, advertising, insurance, and making of a covenant not to compete. And those are the big ones. So I hope that answers people's questions about how exactly the value-added tax would be imposed. So that's the main thrust of it. Now we get into more of the details of exactly how it works. So our next subchapter is the accounting methods. And so we lay out, in general, business entities shall use the accrual basis for bookkeeping. We're going to lay out that should use the cash method is still permitted. If they're already permitted, they can continue to use that. New business entities, change or expansion of business, regulations. The Secretary, the Treasury can come up with regulations along those lines to meet those what we just laid out here. Taxable year means the calendar year in general, but there is a special a business entity that keeps its books on the basis of an annual period where it always ends on the same day of the week. You may end up with a 52 or a 53 week year. And so the Secretary does permit that. But in general, this will start putting taxable years to the calendar year. So calendar year is generally required. And there'd be a short taxable year because the value-added tax goes into effect in 2026. So if they have a taxable year that's not the calendar year, there would be a short taxable year in 2025 that would end on December 31st, 2025. And then the new full taxable year would start January 1st. And if you've got a 52 or 53 week year, under one of the special exemptions, you can these are the special rules that would apply. However, there's an anti-abuse rule. You can't use your 52 or 53 week year to start collection of value-added tax in a way that would if transactions that deviate from the normal course of business are in order to achieve some tax benefit. All right, long-term contracts, basically contracts, the money that you get in is over multiple tax years, is accrued in the year that it was received. If you get it in different tax years, then it applies in different tax years. And definitions for that. Post-sale adjustments and refunds. If you got a refund, then you can deduct that from your taxable receipts. If there are bad debts, you can write it off as, if you claimed it as a taxable receipt, even if you didn't actually collect the money, and then you don't collect the money, then you can deduct it from the next year. However, if you do actually end up collecting it, then you have to treat it as a taxable receipt when collected. All right. Subchapter C is financial products and services. The value-added tax is pretty straightforward. It comes to physical products, right? When you're buying a toaster, it's very clear. But what about ones that are financial, where the business entity is a middleman for these services? And that's what we cover. So we have definitions for financial receipts, instruments, financial intermediation services, and the general rule for taxation is that these financial intermediation services, being the middleman, still counts as a business activity, and gross profits shall be computed by substituting financial receipts for taxable receipts, including financial expenses as business purchases. So slightly modifying, if you're a financial middleman, you don't necessarily have the physical inputs into your service. So we got a little bit of a substitution there. International matters. Again, financial receipts would not include things that are not taxable receipts. And the Secretary will prescribe regulations as needed to clarify anything here. Special rules for banks. So who is a bank? Generally, they're a bank is a separate entity, and then so you have a clear, separate definition for what financial receipts. In this case, receipts, interest on loans, discount points received. These are all their extra financial receipts that they get. And financial expenses are only interest paid, and you have to include foreclosed property. So we've got a definition of bank and other activities. If they're doing other things than what's defined as a bank, then they have to be a separate business entity. So, if they're also selling merchandise, hats with the bank's name on them, whatever, that's a separate business activity. And so the standard value-added tax rules apply. All right, 1624 is insurance companies. They're generally treated as financial intermediation services, like in 1622. And if applying those rules produces results inconsistent with the territorial approach of the value-added tax, it can apply to the Secretary for permission to clarify those things. Financial pass-through entities. These are legal entities where, like venture capital kind of thing, right? So financial receipts shall include contributions to capital. Pass-through entity means a business entity intended to serve as a conduit. So if you're using these to funnel money, then the money that you put in counts as a taxable receipts. All right, now we get into subchapter D, the import tax. And so let's just talk about tariffs for a second, right? There is a lot of talk about tariffs in the presidential election campaign. Donald Trump is proposing tariffs on a wide range of countries and products. And tariffs have a long history in the United States. They were one of the ways that we developed our manufacturing infrastructure back in the beginning. They were an essential part of Alexander Hamilton's first plan for the United States. Tariffs were always used to build up to make it more expensive for other countries to compete. Now, what we're doing in subchapter D is an import tax. It's different from a tariff in that it's also at 12%. So here in the United States, companies will pay that 12% tax, and the import tax will bring our foreign competitors up to that same level, so that there is no disadvantage or advantage to either side. This is to level the playing field in the United States. And that's the purpose of the import tax. So it's different than a tariff, where a tariff is to unlevel the playing field. I don't know if that's a word or not, but you know what I mean. That's the purpose of a tariff. This import tax is to level the playing field. All right. Let's look at these. All right. In general, it's a 12% tax on the customs value of all property entered into the United States for consumption, use, or warehousing. The liability is on the person who brings it in. Imports for personal consumption, anything that can enter the United States duty-free. You don't have to pay an import tax on stuff that you buy overseas and bring back to the United States, as long as it's for personal consumption. And use in a business activity, property being held for sale by a business entity shall be considered held for use in a business activity. There is an exemption here for petroleum, so gas, and any other product that the president shall, by executive order, determine to be in short supply and vital to the national security. So you can waive the import tax if it's for national security purposes. All right, imposition of services. Again, physical objects are one thing. What about services? So if you're a business and you need to hire a computer programmer and you hire somebody in Iowa, that programmer is a business entity that's going to pay the 12% value-added tax. So what happens if you hire a computer programmer in Bangladesh? Well, in that case, then you would be responsible for paying the value added tax. You can't put a tax burden on the person in Bangladesh, but you can make sure that you, as the business owner hiring someone, you're not, again, we're trying to establish a level playing field here. So you're not going to be able to get an advantage because of a tax burden that only applies to Americans. You're not going to be able to get an advantage by outsourcing. Yeah, so the 12% tax shall be paid by the business entity who receives the imported services. And this is in addition to the value added tax. So this is a separate tax. Import of services, anything shall be importing a service if the benefit is realized in the United States and it is in connection with business activities of the business entity. So remember, exports don't count as taxable sales. So if your business entity is selling your services to Europe, then any services that you import for that are not subject to the value added tax if the benefit is the entire benefit of the service will be realized outside of the United States. Service acquired from service providers that provide services in and out of the U.S. And generally, service providers shall treat the services as provided or stated on the invoice. If there's no invoice, they will treat the services provided in the location where the payment is sent. International transportation services, like your FedEx costs, right? If you have to ship things to your goods to Europe, taxable receipts do not include receipts from the transportation of the property exported from the United States, but they do include the cost of importing things if they haven't already been paid for in determining the import tax. Business purchases do not include amounts paid for or incurred for the cost of transportation property exported from the United States. Did you cover that? Oh yeah, sorry. So taxable receipts and business purchases. Exporting stuff, neither one of those is included in those. So it's not a receipt, but it's also not a deduction. Transportation of passengers, right? What happens if you have an overseas flight? Is that in the United States? Is it outside of the United States? And so this addresses it and says from the United States do count, from outside into the United States do not count as taxable receipts. Then the Secretary may provide rules that simplify this, including rules where just it's split 50-50 for anything to and from the U.S. and all transportation expenses of a business entity. Yeah, so the Secretary can simplify this section to clarify, but the default stuff is written here in paragraphs 1 and 2. International communications, again, if you're communicating where exactly is that service taking place, and in general, they're treated as provided at the point of origin of the communication and not imported or exported. So if you're making overseas calls, then that's considered as a service being provided here in the United States. Insurance. So if it's for foreign insurers, it is their insurance. It's an import. The insurance service. If you got insured with Lloyd's of London, their service is an import. Premiums shall be subject to the import tax, but the payments shall not be treated of insurance benefits shall not be imported. And vice versa, if you're an insurance company that's insuring outside the United States, then it's an export. There's no tax on premiums, but anything that you pay out is also not a business expense. And banking service, banking is complicated, so this section gets kind of punted to the Secretary of the Treasury to prescribe regulations and to the extent which such services are treated as imported or exported. All right, subchapter E. These are the rules for administration, how we do tax returns and things like that. Section 641, this is where individuals where individual rules apply. You see a reference here to until subtitle F is amended to reflect the adoption of this chapter. We'll get to that in a second. But to start, this is individuals shall be permitted to file their business tax returns with individual tax returns. You don't have to do special returns. 642, consolidated returns. If you're a business with many legal entities, you can still file consolidated returns under existing law, as long as you're consistent in how you treat intercompany stuff. And financial intermediation services can do the same thing. So gotta be consistent. All right, section 643 is the seller's liability for tax, and the person who's selling the property or service is liable for the tax. Again, this is a business tax, consumption tax. The business tax that is passed on to the consumer. Deposits may be required, sort of like you have to prepay your taxes now, like quarterly or monthly prepayments. For any taxable periods can be a quarter, a month. Tax point, the point is the point that the tax goes into takes effect, and that's in the case of importing property. The tax point is when the property is entered or withdrawn from warehouse for consumption in the United States. If you have tax liability changes, section 644 requires you shall notify the secretary of any change in the way that your business is conducted, which might affect the liability of the value-added tax. And last but not least, regulations, authority for the secretary to prescribe regulations. All right, let's blast through the last of these. Okay, section 653, that's all the new stuff that we've added, and no questions in the chat. All right, secretary, within a year of passage, the secretary shall submit to Congress proposed changes that will revise subtitles C through J. And you'll notice the letter F comes through, is in the middle of those, to fully reflect the amendments that this title makes, and includes statutory definitions where needed. Application of subtitle F. Until such time as subtitle F is amended, these provisions shall generally apply to the value-added tax, without regard to specific cross-references, without reference to partnerships, and so generally as if it was the corporate income tax. So, and then effective dates. The amendments shall be effective on and after January 1, 2026, after the American Union Jobs Program is in effect, after people are collecting their unconditional basic income. After that is when the consumption tax will kick in, value-added tax. And once again, special rules for businesses: no cheating with that 53-week year. You can't you can't do transactions that, no cheating. You can't structure transactions to take advantage of this application of this title to a business when the title didn't apply to other businesses or individuals. Okay, that was fun, right? Everybody had a good time? All right. Again, the Trump-Biden peace plan is a very specific legislative proposal. It is not just a nebulous idea that's being thrown out at the wall. And so if we say we're going to tax back UBI with a value-added tax, you got to say exactly how. And so that's what this section does. I think that's going to about wrap it up for tonight. My fast is continuing and will continue until October 15th. You're invited to join me on October 15th, which will be my 24th day for 24 hours for a fast for peace to de-escalate the 2024 election. My weight's down to 181 pounds. Feeling a little under the weather today because I'm getting tired of drinking water with electrolytes in it, so I haven't been doing as much of that as I should. But hopefully I'll be doing better tomorrow. All right. Thanks, everybody, and hope you join me tomorrow for... Actually, what do we got going on tomorrow? Tomorrow is addressing social and cultural issues. We're going to talk about how the American Union model is a constructive program, holistically trying to address a number of things in the United States, not only our political problems. So I hope you join me at 7 p.m. Eastern. Thanks. Have a good night.